All right, we got our FOMC meeting. I saw some people kind of call him the Mr. Softy. Powell came, instead of using his bully pulpit with the whomping stick, he basically just said, yeah, you know what, everything is just fine. And we're achieving what we're trying to achieve, and we're pretty close to finishing what we're doing. It seems to be the tone that the stock market took out of his press conference. Again, ahead of some important earnings here coming up from the FANG names, and then as well as ahead of an important jobs number that was actually mentioned today in the press conference. So big move to the upside, kind of a lot of breakout type signals flashing today. Very similar to other times we've seen in the past year, but there's some good opportunities here. So I'm going to break down these breakout signals, what they're saying, how important this level is, how important the levels are at the highs of the day today. I'm going to show you that. I'm going to show you some interesting charts that will show us what's driving this price action. And you can see, obviously we know the news event, but you can see how it impacted different asset classes and the sector rotations. We'll break that down today as well. One sector in particular not joining the party, and we're going to trade it. So let's go ahead and get started. Today is Wednesday, February the 1st, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, you can check out some of these other things on the right, including some of our popular posts. Brandon just updated his dividend sector statistics there. Come down here, click on this heart. It opens up this tab. Click that like button. Again, do the same thing here with the Facebook, click that like button. Again, the more you do that and like these posts, you can do right now while you're watching. It helps us tremendously, actually. It helps get our content out to all of our followers there. So again, we don't charge for these videos, but if you could just like those and repost or share, comment, that goes a long way in creating a lot of value for us. That's why we always ask for it, and we thank those that do that day in and day out. All right, let's take a look at the S&P with the market forecast, and you can see the intermediate lines now near the 90th percentile, and we got pretty close to a cluster. We did get the momentum up to 74, or actually dropped to 74. We were very close to a cluster at the highs of the day, right before that late drop, and then of course the near-term line at 77. So that close, we're almost 5% above, easily above the 30-day moving average now. We closed above all of these levels. We closed above all those highs, 4,100 there, 4,100 there. So we closed at 41.19. And you have your market sentiment line rising or falling, here at 63. So we do have, it's a pretty good move, easily above 4,000. You can see that next important line here. We talked about this in our class today, right about 41.50, because the high today was 48.95. So you can see now it's a 50% retracement of the correction that we've been on, and then the 78% retracement of this intermediate rally that we never ended retracing. We just got in the retracement zone and stayed there, up and down, but stayed there. So remember, retracements end when you get back below the 23 or you change the trend above the 78. So that's where we're at, right? We are that close to changing the trend. And remember too, from way back over here in August, when you get above that 50% retracement, we never get back down below it. Now, we never get to new lower lows. Now, so this was the one time, because before this time it never did. But this time it did, right? We got above the 50% retracement there, and then it got down to lower lows. So I can't remember who it was on Twitter who posted that we never go back to those lows after you've retraced 50% of the pullback or the decline. So we did there. So here we are again. So obviously the odds are that we won't. So when you add that on, with the idea of breaking above the 78% retracement of this intermediate line. You can see why 4150 is really important, right? Getting through that would just basically end the correction, and we'd be up, going to the upside. And you can see how close that 23% line is. Remember, you retrace when you break below the 23% line. You stop retrace when you get back above it. So, I mean, this is the retracement of the COVID rally, right? The post-COVID rally. So we started that retracement back in here. Basically, it's the correction, and then now we'd be ending it back above. So look how close we are. And if you look at the Dow Jones Industrial, remember from before, we actually have crossed all these levels. We have crossed the 50% retracement. We did that a while ago on the Dow Jones. We have crossed above the 78% retracement. We did that over here in November, December. In fact, we flipped the trend to the upside now. So we retraced it below the 23 and we got back above it. So we had a pullback, and now we're back up above, dark green shading and a green line again. And then we are above the 23% retracement of the post-COVID rally, well above it at 34. So the Dow is what we want, and has been for multiple months now, what we want the S&P to be now, right? That's how close we are really to changing things around. Again, you look at the NASDAQ 100, which obviously is a big part of the Dow. The 50% retracement's way up here. So there's the 50% retracement. There's the 78% retracement of this intermediate decline. We're just now getting above the 50% retracement of that decline. We're still holding the 62 there. And then there's the 23% of the post-COVID rally is way up here at the top. So you can see the NASDAQ's way behind the Dow. The Dow is really up, bullish. The NASDAQ's trying to get more bullish. In fact, it's the most bullish above the 30-day moving average. It's probably the second most bullish. We're at the 98th percentile that we've had all year. So it's been a really good bullish move. So it's getting there. And then again, the Russell 2000. There's the 50% retracements of the post-COVID of the current corrections way up here. The 78% retracement we just broke above. You can see there's the 38% retracement of the correction, the 78% retracement of this intermediate line, and then the 23% retracement. This is of the 2009 low, the big bull market low that we had started to retrace back in there. You can see that the post-COVID rally is way up here. So, I mean, even the Russell's way far behind the Dow of getting way up here. But you can see, again, you can see how important this level is. I mean, we are really, really, really close to just killing this correction and getting up to the upside move here. So we are also kind of set up for a fake out type move if we cannot hold this rally. Now, tomorrow we got a lot of earnings on the docket, a lot of earnings, big time earnings, and then after the market, and then Friday we have the jobs report, right? Which obviously was mentioned today in the press conference. So we got 2 jobs reports and 2 CPIs coming out. Incidentally, the 2 CPIs that are coming out here that were mentioned by President Fed Chair Powell, these are the 2 CPIs that are expected to come out, and they're both expected to be at 0.63, 0.6 and 0.63. So when you look at where the CPI has been in the last little bit, here you go. So we dipped below 0. 0.6 is way up here, right? So having a couple months of 0.6. In fact, what ends up happening is you can see the percent change is down to 6.42. The Cleveland Fed says we're actually going to bring that up next month, not down, but up, and we're going to drop down to 6.24. We had been on a really good pace of dropping as much as we've been rising, but now that pace is starting to slow down. Again, that's the concern. Bringing inflation down is not the Fed's goal. That's the easy part. Because they can raise rates. It's easy to bring it down. What they don't want to have happen is for it to go back up. Because if you look at, go back to all these other years, you can see that if you don't kill it, when it comes back down, like at about 5%, when it comes back down, it came back down to a higher low point and then ended up going to a higher high. And again, if you don't kill it, then it comes back down to a higher low and goes back up to an even higher high. And we saw that in 2000. 2000, we came down to a new low. It didn't kill it. It got up to a higher high in 06 with the housing bubble. Didn't kill it. And it got up to an even higher high in 2008. So, I mean, obviously a much smaller scale than what we saw in the 70s. And this would be more closer to the 70s. But the next high point, the next low would be obviously be much higher than that post-COVID low point, if and when we ever do bottom out. And then if we do bottom out, say at 5 or 4% or higher, then you would expect the next high to be higher than this 9% that we got to. And that's what the Fed's trying to stop right there. They're not just trying to get inflation to come down. That's the easy part. They raise rates, they get it to come down. They need it to stay down. And I don't think a lot of people are understanding that, because if they did, they wouldn't be looking for the Fed to cut rates in December. Because if the Fed's expected to cut rates, and they're 90% odds that they're going to cut rates in December, because there's, an 82% odds that they're going to raise rates again one more time in March. So that means there's a 90% chance, and there's a pretty darn good chance that they're going to cut it another 50 basis point, down to 450. There's about a little bit better than a coin flip chance. They're going to cut it 2 times. So you get the idea that if that's the case, then we are susceptible to either the recession because they're cutting rates, or if we're not in a recession, a renewal of a potentially a higher high, because that's what they did here in the mid-70s, is they started cutting rates before the real Fed funds rate got positive. That's what they did over here in the 76, 77. They started cutting rates before it got positive, and we got the second, we got higher highs. So we've seen this playbook definitely play out before. All right, let's go back to this chart. Let's take a look at the weekly chart here. And you'll notice that we did close easily. Well, we're still 2 days away, but we are easily closing with a higher high. We're not quite closing above the high point of last week on the Hakinyashin basis, but you can see how we're definitely above the 40-week moving average. Probably the highest that we've been. We did get up this high in August, and it didn't hold, so it's really important that we do hold. Obviously, we got up above that high in March too. So now it's a matter of whether this holds or not. But you can see the PPO is really we're almost got the golden cross. Remember, we've already did get the golden cross on the Dow Jones. We've had the golden cross for quite a while now, and it's just been a matter of stalling here. The Nasdaq, of course, has been more bearish, so it's a little bit further away from the golden cross. But this is the first week that the Nasdaq has closed above the 40-week moving average since back over here, right? It closed a smidgen above it too, and it also closed a smidgen above it there in March. So it's not. I mean, this move we're getting this week we've had before. We've had it in August. We had it in March. We've had this kind of move to get up to the levels that we've gotten to. Now it's a matter of whether we'll actually hold it this time versus the other 2 times. We look at the 3 green arrows. Of course, we have 3 green arrows all across the board for an extended period of time. The MACD has turned back up. The histogram has turned back up on all of these. So we got a little bit of a renewal of the momentum to the upside. You can see easily above the 200-day moving average. 8 and 17-day are above it. See, the 8 and 17-day never did get above it in November or in August, and a little bit there in March. You can see the 50 and the 30-day are about to get above the 200 and they get above the point of control. So really, really good move from that perspective, helping to solidify this breakout. The positive indicator got above 35 again. For the first time, the negative has dropped below 20 for more than a week. That's the disparity you need to get the ADX going and to get a trend going. So that's a good sign for the markets. The Ichimoku cloud finally broke through that barrier. It's above 2 now. It's above 65. So you have an intermediate trend strength. Very good rate of change. Easily above the cloud. So looking really good from that perspective too. The RSI and the CCI are in bullish levels, above 60, above 100, above 150. So good sign from that perspective. You can see good things all across the board. The whole, we've been now 20 days. You can see that parabolic SAR is really close. So that makes it a little bit hard to bullish moves don't start with the parabolic SAR right there. I mean, we can get a little bit of extension of a move, but bullish moves don't start with the whole already green for 20 days and the parabolic SAR is that close to the lows. So that's a little bit of a concern in terms of how much the momentum will carry. I mean, it doesn't mean that we're done with the bullish trend, but we've had so much momentum to get to this spot. It's a little, like it's unlikely we'll continue this momentum for an extended period of time without at least a small pullback, and then a renewal of, again, a breaking of this parabolic star. You can see something like this, breaking the parabolic star, getting a brief period of red arrow, I mean, even something like this too, and then get a new 20-day period going. That's something that we'd be probably be looking for within the next week or so. Again, depending upon how bearish it is, will tell us how likely we are to get a new bullish move going. So here we are at 4,100. Again, we were over here at 410.97. We're at 410.80. Obviously, the money flow is nowhere near that level at the 50% mark. So again, we're going to be approaching the last time we've touched the 50% mark with nowhere near the volume at this point that we had when we first touched it there. So, money flow index is forming lower highs and lower lows, and it's already, we've already got this surge. We've already got the surge in the McClellan oscillator too from a breadth standpoint. We are above 1,000, right? We are above 1,000. We are still, remember I showed you before, the last couple of corrections we've had, when we've hit 1,000, you're above the 62% retracement there. You're above the 78% retracement there. This go around, because of today, we're at least more above the 38%. Before, when I tweeted this out yesterday, we are barely above the 38%. So we are above 1,000. That's solid now. Even if this, we can't get above 58 again. Again, we've had our surge in breadth. It got 1,000th of a point above 100. So we've had our surge. Now the question is whether, we'll continue this surge or whether we'll do something like this where it kind of peters out and then we get a pullback, right? That's kind of the idea. Again, especially considering we've used so much. We went from below 1,000 to above 1,000. Like to go below 1,000, like we did here, to above 1,000. Like again, that's a surge. That it takes a surge to get that, and you would like to have gone through most of the corrections move on that surge, right? Like you did here. Again, 78% there. So on the surge here, you got through most of the corrections retracement by the time you got to that point. Here again, we're still haven't gone through even half of the corrections retracement yet on this surge. So, that's kind of like, have we used up too much energy just to get to this point and not enough to actually change it? Because once you break the 62, you don't need very much energy anymore because the hardest part's getting through that retracement zone. We're still stuck right smack dab in the middle of that retracement zone. So still a lot of energy needed to break through what would be the August high point and really get it going now, with some escape velocity, so to speak. So that's the McClellan oscillator there. You can see we're easily in a very high range, but have been in a very high range of the 4-week. In fact, when you look at the Arun indicator here, you can see again we did get a new 4-week high point. Obviously, the low point is back over here, so that means the red tag is so close to 100. We got a new 4-week high. The range is at 8%, but it's not above 10. You can see on some of these others we easily got above 10 on the August peak. Over here we got above 10 on that peak when we started getting the new highs on this one. We got above 10% before it started to grind. Here in March we got above 10%, just barely, but we got above 10% there on the side, on the width of the 4-week range when we broke out there. So here we are again, not getting above 10% yet, above 8, but you can see we kind of need to extend to new higher highs for the next few days to really start to push this above 10% before we grind to whenever that happens. So at least we did get a higher high today. Boy, I just hope that that's not it. If this is a fake out going through the earnings and jobs report, if this ends up being a fake out, it's going to be a really bad. I heard someone say, I think it was JJ Kinahan today on TV said, no, it wasn't. It was somebody else. Oh, Josh Brown, I think, said that this seems like the move that has capitulated bears bearish traders to say, okay, I'm done, or at least has capitulated the traders who have said, I'm waiting for a pullback before I can buy the dip. Now there's just people saying, okay, just get me in with whatever. That we've gotten to that point in the market. And again, that's usually a hallmark of fake outs, when you suck in the FOMO crowd. They're the weakest hands because they haven't gained any of this, and that sets you up for the fake out. So hopefully we can maintain this and build off of it and not get sucked into that fake out there. The volatility index really dropped hard today. Again, considering too that you still got a couple, all the FANG earnings and unemployment. So it's not like we're out of the woods here, but we did close below 90%. Again, not the first time in the last few months, but it is the first time we closed below 18 on the VIX over the last few months. So I mean, that's the lowest point of the last few years. Again, it's a seasonally bullish time for the VIX, and the VIX as of right now for this particular year is down 22% already. And generally on this day we tend to get weakness here coming out of February, where we get a little bit of a dip, but we're generally up. The VIX is up at this time of year, and you can see it really starts to go up going into the middle of March. So we're starting a seasonally bullish time of year with a really significant downside, and you can see the correlation is strongly negative. The VIX is rising, the S&P, or VIX is falling, the S&P is rising, and you can see not only did the VIX drop, but you can also see the VVIX drop too. So the VVIX, which has been correlated with the VIX, and the VVIX dropped to 81. You notice again the correlation still is below 0.5. And anytime you get below 0.5, which is a weak positive correlation, especially when you get below 0, and when you have a negative correlation, that's not bullish, or that's not bearish for volatility. So it'd be nice if the problem is the VVIX is already so low, and there's not much lower for it to go. The VIX, we know. Remember, the VIX is really, really low, like not only from a seasonal standpoint and everything else I just showed you, but when you look at how far below the 200-day moving average the VIX is right now. So we'll go to the simple moving average here. Like we are the lowest point of the past year, so 0%. That's the lowest point. We are what? 29% below. We're 29% below the 200-day moving average. It is near the lowest point of the last 5 years, and the 1th percentile, whatever that is. And then you go out to like the last 10 years, which now would include like 2017, when we were extremely low on the VIX. Again, we don't generally get this far below the 200-day moving average. So we are in the 1st percentile still on that too. So needless to say, the VIX is really, really low. And also needless to say too, the VIX has compressed, and it may be breaking out of that compression if this really rises higher. But the VIX has been below this 10% mark for months. So the VIX has compressed this whole time. And, if today ends up not being a fake out, this could be the breakout out of that compression, but to the downside. Again, with a very low VIX and a negative correlated with the VVIX, but still, I mean, this would be a breakout to the downside on the VIX and potentially on its way to 15 and lower, right? Which is where it gets to when you're bullish. And not for that matter, too, the rest of the broader market, where the volume has been, relatively low relative to the 52-week range. The ATR has been really low relative to the 42-week range. And here we are at 1.5%, potentially making our way. Now, again, we don't want this to rise, so we'd like this little blip up to be a one-day phenomenon, because we want everything to settle in and grind, right, with this going down. Because you get below 1.5%, you're bullish again. We haven't been below 1.5% on this ATR to price in quite a while, right, since this bear market started. We were briefly below it over here at 1.43 in August, but we haven't really been into this lower half. And again, when you get below 1% is when you're really just trending. As you can see, that when you're bullish, you get below this 1%, but you're definitely below the 1.5% mark on all these levels when you're on this bullish trend. So that's how close we are to getting below the 1.5% mark here. All right, most of this bullish trend that we've seen lately has been led by the weakness in the dollar, and that was the case again today. Interestingly enough, the weakness in the dollar has pushed gold up, has pushed emerging markets up, and for that matter, developed markets too. Stocks have been rising. Bonds have been bullish, which means yields have been down. Again, that's been the triumvirate. The reason for the bearishness in 2022 was the bearish bonds, and so bullish for yields, higher commodities, and higher dollars. So all three of those things have reversed over the last 3 months. It's interesting to see how bearish commodities have been with the weakness in the dollar. Let's look at just today, and you can kind of see the post-FOMC reaction here. We were pretty bearish going into the day. You can see emerging markets started off today relatively strong, came down with everything else. Well, at the end of the day, the Qs were the biggest movers. Russell up 1.5%. The Dow was barely positive, so the Dow really lagged behind most of its peers. But look at that big drop in the dollar, and look at the weakness in commodities we already had and still had coming in. So that's an interesting conundrum there, because again, commodities are still in a downward move, and for that matter, may still actually be in a correction. And what's interesting is commodities don't correct in bull markets. So if we are going to continue on this decline back below the 17 to 8-day week moving averages, and we fill in this gap, it's going to be hard for equities to continue their bullish run if that's where commodities are going. On the other hand, if commodities keep rallying, which is the reason why this is up, because gasoline prices are moving up. So if commodities keep rallying, we've seen lumber prices move up, we've seen metals move up, but you can see we don't necessarily want those, because that's what, a lot of they went up during this period too, not that period, but over here in March, early 2021, when we were in that the strongest move higher in that inflation level, when it really kind of got unchained and went higher. Here we are already at high levels, so if it goes unchained again, then either inflation becomes an issue again, or again, if they're in correction, and it's kind of hard for risk appetite to be bullish when commodities, which fuels economic expansion, is in correction. For the most part, stocks or the markets, the volatility is higher, and markets are struggle when there is a correction in these commodity prices, especially crude oil prices there. So that's definitely something to keep an eye on. You can see UUP broke down pretty hard today. There's the weekly chart. It's breaking its own Fibonacci retracement here at 62. You see how important that would be to continue its correction back into that level. You can see the bond market, interestingly enough. So the dollar has been bullish, right? So the dollar leads bonds, bonds lead stocks. So that strong bullish dollar ultimately would lead to rising bonds. Again, it's going to be hard for stocks to be too bullish here, or bonds to be too bullish, if stocks are bullish, right? Especially, again, that's the case in inflationary environments, but since we are, at least according to Fed Chair Powell, now in a disinflationary environment, he brought that up multiple times today. Now we're back to where bonds and stocks move in opposite directions. So a rising bonds would be a demand for safety trade, and that's going to be, that's not necessarily the thing we want to see out of bonds. So you have, the dollar falling and bonds rallying, but the 10-year yield dropping to 3.5% or below the 3.5% mark. Again, it's like, can stocks rally with the 10-year yield dropping as much as it is, and especially breaking below, significant levels here? If I bring up that correlation chart again. Here, let's actually do this. Let's bring back up that chart and look at the weekly chart, and then let's add on a correlation between, a comparison chart where we can throw on. Let's do SPX on this one. And then on this, let's pull up TNX. So you can see going back, if I were to go back further, let's go back 20 years for some context here. So you can see the times. I don't know why it's not showing that. There we go. You can see the times when TNX has been dropping below the moving average. You can see that has been relatively bullish for equities here. And then you can see, but during a period, but you can see it created more volatility during that drop, and especially here you can see equities drop. You can see over here too that when 10-year was dropping, we had some volatility in 2010, 2011, and all that volatility in 2012 before they both went up there. Now you can see it during this correction in the bonds. We had that 15-16 correction there. And then, of course, we saw what happened in the fourth quarter of 2018 where they both declined. And then inflation started to ramp up, and they both went up together, right? Stocks and bonds went up together here. So, but again, coming back to a disinflationary environment with yields breaking through some major resistance or support levels, excuse me, from a moving average standpoint, you know, are we going to be able to get stocks and bonds going up together here in a disinflationary environment? That's not the normal trend. They usually, you know, obviously move opposite of each other. From a sector standpoint, you can see that the not surprising what were the biggest performers today from a sector rotation. Here, let's go over to just today. The best performers: discretionary, technology, communication services. So your big three were your biggest winners, up 2% or more. The S&P is up 1%. Energy really struggling. That was one of the biggest losers. And you look at the Market Watch tab here, and you can see, okay, what were the biggest, you know, gainers? And you can see it's not surprising. Some Chinese stocks, but you can see Google, Amazon, Microsoft, Apple. These all have earnings, right? Apple and Amazon and Google have earnings coming out. Facebook came out with earnings tonight and did really, really well. The stock was up 3% going into it. It's up 18%, or well, at least last I saw was up 18%. So all those stocks, but look at that energy complex bearish. Some healthcare stocks were also bearish. Amgen, bearish here. AstraZeneca over here bearish. You can see the chip stocks are all really bullish today. 7% move higher in Nvidia, 6.74% in Applied Materials. A good earnings report from AMD, up 12.5%. So some big movers in that front. You know, of course, the some of these consumer discretionary names, Target moving up there. Costco had a pretty decent gain, but like I said, some bearishness there in that sector. So when you look at like Schlumberger is our example here today. Schlumberger, you can see, oh, that's S&P. Schlumberger, you can see the bearishness there. You can see the intermediate line is crossed below. It's down out of bullish territory. It's below its market sentiment line. We're falling. We have pink shading, but not the yellow line yet. When you look at the weekly chart for Schlumberger, you can see we had a lower, well, slightly higher high, but we're definitely getting a lower high this week. And you can see the PPOs rolling over after being at really, really high levels there. Looking at the 3 green arrow chart, when you split the lines out, you can see we did close below the 17-day moving average. We have been in convergence mode for a while, but now we're closing below, and you can see there's that pretty wide gap again between the 50 and the 200-day moving averages. So there's some, and you can see the divergence, higher high with a lower high on the MACD. We are setting ourselves up for this stock to have potentially a period of weakness here. You can see the lower highs in the RSI as well, and the CCI getting down into bearish levels, starting to work its way down to bearish levels. I didn't show you the Bollinger Bands on SPY, but the SPY did close above the Keltners today for the first time. Now it closed above the Keltners there too in November, and then failed. It did that in March too. The one day it closed above the Keltner channel finally in March, because they never did get outside the bands in March, just like it hasn't gotten outside the bands here. And then the one day it did get above the Keltner channel was the bullish day. So that's why it's like, let's see if we just don't get that here. If we can just continue to push without getting that kind of fake out would be really, really nice. And the thing is, tomorrow, or especially Friday's got all the makings to be a pretty volatile day because of all the earnings due out Thursday night, and then the employment report due out Friday morning. With the momentum already so bullish just to get to this point, to never get above the Bollinger Bands, which is kind of what you need to start a trend, and then to finally get above the Keltner channels for one day makes you wonder a little bit, especially on such a big range that we had today. But Schlumberger, you can see, if I pull this back up, you can see its bandwidth is really, really low inside of its Keltner channels, having some bullish momentum and transitioning potentially to a bearish momentum through these red dots. We are setting ourselves up for some weakness, but not the directional. Obviously we're not breaking down below support or trending lower, so I can't be too aggressively bearish here. So what I decided to do was sell a bear call spread, sell the 57.5 call, buy the $60 call. It sets us up for a normal position size for about 474. That break even, you can see, is right there. So essentially, we would have to get back up above its 4-week range here. You can see we're through that earnings already. So we'd have to get back up above all these highs and really get going the new highs for us to be kind of done with this trade. So if it goes down, great. You can see there's got, very, very top heavy in the 4-week range volume. If it breaks down, great. And I can get 50% quickly, great. Otherwise, if it just stays below all these highs and just does whatever it does, that's good for us too. That's kind of the intent behind that trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Like us on Twitter and Facebook. Follow us on those accounts as well. Join our website at marketscholars.com for free. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.